Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending September 19th, 2025. And I'm host of InvestTalk, Justin Klein. And today's video is titled, "Does a bad labor market spell an end to this bull market?" We know labor data has come in fairly soft, and we'll get into that data. But the big question is, what's happening in markets? And this is the heat map for the week of the S&P 500. You can see there was a good amount of green, especially the bigger names, Apple, Google, Meta. Those were all pretty solidly in the green. And you had some big movers, names like Crowdsource up 15%, Tesla up nearly 15% there. What's this one? This is Applied Materials up 13%. But then you look at some other names, Broadcom down 5, Nvidia flat. A lot of the consumer staples were down. A lot of the healthcare names were down. A lot of the financials were down as well, especially around the insurance space. Names like Progressive and Chubb are down, but you also had some nice green. Some of the bigger banks, investment banks, even the Blackstones, the KKRs of the world, those did fairly well. Then you go down into retail, you'd had a lot of red with Costco and Home Depot, slightly lower lows, TJ Maxx, etc. And then you had names like AutoZone down pretty decently, Ross Stores, etc. So certainly a mixed picture for the week, but overall the bull market still continues, and that's what we're going to try to answer today. Is this the end of the bull cycle? Right, we're certainly overbought in markets, but as you know, or if you have any experience in markets, you know that overbought conditions can stay overbought for longer than you expect, and frankly, over the medium to long term, overbought conditions are good. That means that you're in an uptrend overall, and we are. And the question is, when will that end? And I'll talk about that here in a little bit. Now, this is the economic data for the week. We had the New York Fed Business Leader Survey, and you see that rolling over once again. It improved from the lows after Liberation Day in April, but it's certainly rolled over, and we're back to those levels. So that's just the New York region, but something of note. But what you're starting to see is the tariff picture certainly hitting the prices of exports, right? The cost of actually shipping those out. You have a weaker dollar, so those prices are certainly going up. And then you have obviously when you're importing a lot of the raw materials and things from other countries, that certainly those costs are rising. So that's feeding into export prices. Same with import prices. That did dip into negative territory, but it's back to flat now. Your housing starts, that's rolling over. You're starting to see, you saw a little bit of rebound in the summer selling season, etc. But now we're getting into the fall, and these home builders, they don't want to sit with a bunch of inventory through the winter, and they're kind of just holding on to their current inventory, even building permits. They're not even applying for a lot of new ones. This is a 5-year low. So clearly the housing market continues to deteriorate. Now on the labor front, speaking to kind of our discussion, or the title of this video is a deteriorating labor market. Last week it was interesting. There's a big spike in initial claims all the way to 264, but there was actually a report that this was actually due to a lot of fraudulent claims that were actually end up being denied. So this was kind of a data point you want to ignore, and it's come back down to 231, which is kind of in the range that it was before that week. On the continuing claims, which I always say is more important, who's been approved, who's actually getting those unemployment checks, and then who's staying on the doles. Now, the longer this stays elevated, you start to get people that are beyond 6 months, and then their unemployment checks run out, and then boom, now you're off the doles, even though you didn't get a new job. So later in a rougher economic cycle, coming out of recession, it's less useful, but with our economy slowing, this still, I think, has a lot of predictive power, or does tell a story about the labor market, which is it's not great, not as good as it was last year or earlier this year, but it's also not extending to the upside above 202 million on unemployment. And so of the labor market is weakening. It's not falling off a cliff. Let's just say that, because there's not a ton of layoffs. We said that before. Not a lot of hiring, but also not a lot of layoffs either. Now, let's get into whether that modestly poor job market is going to end this cycle. And I'm going to start off with this, which is the US Treasury surplus and deficit. So it's very important to see, especially in the world of whatever 6% debt to GDP ratio, or sorry, deficit to GDP ratio, very high, especially outside of the uh, especially outside of a recessionary period. And what you see, this is rising, and most people would say, okay, the deficit's getting lower. That is a good thing, and over the long term, that's definitely a good thing. But over the short term, that is incrementally negative for liquidity. Now, what you can see here is on the left, this is a 1-year chart. It's still lower than it was a year ago, which means the deficit on a year-over-year basis is rising, but it's also falling on a shorter term basis. And eventually, if this continues to go up, then that is going to turn into negative liquidity coming out of the government. And with a Fed rate cut and so much debt, it's actually going to make this problem a bit worse as we head into 2026. So the reality here is you have to watch this, and this is most likely to become a drag on the economy in the first half of next year. Now, it's not the only thing that matters, but it's a big factor because of how important or how big government spending is to the broader economy today versus 50 years ago. What's also important, though, and the entities that get dollars out into the system, get liquidity out into the system, it's not just government spending, but it's also private banks. Are they lending or are they not? Is lending rising or is it falling? And this is a year-over-year chart of bank credit. And this really took off in April. Now, a lot of that had to do with Liberation Day and companies drawing on revolvers and businesses just trying to cover the near term their funding needs. But that's still, at the end of the day, that's keeping people employed. It's one of the reasons why there's not a lot of layoffs. And if that's the case, then liquidity is still flowing, and companies can still finance themselves. And companies don't like to lay off people unless they have to, especially small businesses. Half the country is small businesses, and so this is positive. Okay, and a steeper yield curve with the Fed cutting rates over the shorter term is going to be positive for this particular channel. Now, over the medium term, it's negative for that treasury aspect, right? The deficit aspect. But overall, in the short term, this should incentivize near-term lending growth. And so far, it has. So that's why, to answer the question, is the poor labor market going to derail the growth cycle? Probably not in 2025. Now, could it derail the growth cycle in 2026? Absolutely. But that's over 3 months from now. And it's not going to turn on January 1, most likely, right? If it does turn, it'll turn at some point later in the year, probably second quarter and beyond. Probably not first quarter. Okay. So just a heads up on that, just kind of before you get too bearish or, raise too much cash. I understand that. Let's get to Bitcoin as well. Everyone wants to talk about Bitcoin. And I think this is of note too, because this will likely peak as it did in 2021. It'll probably peak before the equity markets. And this peaked in August. Now, it's hanging in there. It's just kind of been consolidating here over the past, let's go to a monthly chart, between 107 and 117. Got a high early in August around, 123. But basically between 110 and 120, it's kind of consolidating. And overall, that's fine. It's kind of neutral. It hasn't really gone anywhere since the beginning of the summer, right? So it's usually a liquidity proxy, but there's also not really a catalyst for another move higher in Bitcoin. So right now, it's just not really telling you much in one way or the other. What's interesting of which I'll show you a chart, is that gold is now drastically outperforming Bitcoin. Let's talk about the Fed. Fed cut rates last week. Once again, everyone's getting bullish on that, and I think in the near term for lending, it's bullish. But once again, they will lower the deficit, and ultimately that is negative for the economy over the medium term. Now, they're likely to cut again coming up next month, October 29th, right for Halloween, right? 92% chance there. And then we have a 78% chance that there will be 2 cuts between now and the end of the year. And then you go all the way out till December of next year, your modal outcome is down around 300 basis points. So you're talking about 4 to 5 more rate cuts between now and the end of next year. Once again, everyone thinks that's bullish, and it is bullish in the shorter term, but once the yield curve is sufficiently steep, that's going to drive more lending in the short term. But you cut enough, and that's actually going to zap the income channel, right? Think of all the treasury debt that's out there, all the money you're earning on your bank accounts and your treasuries you own, and the high yield savings accounts and CDs and things like that. That is an income to individuals. And so if Fed cuts rates aggressively, that's actually going to be negative for the income channel. And that will be negative for the economy. It's paradoxical, excuse me, but that is the new regime we're in when we have so much debt. Okay. So understand, this isn't your father or grandfather's market. This is a new arena we're working in with massive amounts of government spending and government debt. That's a very, very important part of the broader economy and the way the economy operates. So let's talk a little bit about the charts here. Let's go to some of the market indices. I'm just pulling this up. So we'll start off with the NASDAQ. NASDAQ still remains strong. We're overbought, right? This is overbought. Now, does that mean that once again the market has to turn? I mean, we're overbought here, and the market had a couple week pullback, and we've continued on higher. Now we're getting this 3-bar surge at a high that tends to be kind of an exhaustive type of move, but it doesn't have to be. But if you look at the volume, let me go to the Qs, right? And the NASDAQ, let's get the Qs because you'll get more volume metrics. You got a pretty good volume. Let's go to a weekly chart so we can see what the volume looked like on this weekly chart. Yeah, it was certainly above average. Let's go look at the SPY. Pretty similar, above average, but not extreme, right? Not extreme. Okay. Let's go to the daily here. Yeah, last few days, pretty high volume over the past 3 days. So that's of note. Usually it's what you get at the end of moves is kind of extreme volume. Now, one thing you have to realize is, yeah, it's high volume, but it's option X last week. So that's probably a big reason for that particular volume spike. So, it's hard to really say there's a lot of evidence that we're going to turn here, but in an overbought situation, kind of any catalyst can turn that. And often OPEX is a time where trends can shift a little bit, or you can have a modest pullback in markets. Doesn't mean you have to have a big pullback, right? It could just reset to something like the 50-day moving average, which on SPY would be down here around 640. Let's go to SPX. Right, the 50 days here, right around 6,400. So could you have a setback to 6,400? That wouldn't shock me either. But once again, you don't want to get overly bearish. Any pullback probably should continue to be bought until 2026. That's the reality situation, especially, we're closing out September pretty soon. Then you have October and you have holiday season. Once you get into mid-November, the odds of a major market correction become very, very low. Okay. So that's the reality situation. Whether you are happy about the economy or not, it's kind of irrelevant. It's all about the liquidity dynamics in markets. I want to show you this. This is interesting to me. So here's IBIT to gold. So this had been trending higher, right? But now it's starting to really break down, especially if you look at IBIT to the gold miners. Gold miners are starting to really, really break out, right? So, and IBIT is Bitcoin, obviously. So this is really, really breaking down. So gold miners are drastically outperforming things like Bitcoin, and the market's starting to price in. And hey, the cost for mining gold for a lot of these miners is 2,000 an ounce in that range, give or take $200, depending on the miner, right? But now you're at gold at 3,700 and moving higher. These are huge margins, and that trend doesn't look like it's shifting, right? And so these miners are going to earn a lot of money for a long period of time. They're going to pay it out of dividends, buy back stock, etc. Okay, so just a reminder there. Let's look at some of the private equity names. This is interesting. You're getting divergence here. You got a resurgence. You're trying to test these highs. I don't think that these are going to break out. I'll be watching these to see when these roll over as well. Like I think this will be a sign that maybe the market could be toppy, but you haven't really seen. You've seen just, and this has been an uptrend. Any pullback has just been to moving averages on these names. Okay, so you don't, once again, want to get too bearish on the markets until you see some signs of other areas, more credit sensitive areas of the economy or the markets rolling over, and you're still not getting that. Okay, here are the banks, down day on Friday, but still in an uptrend. Financials in general, just grinding higher. Look at credit spreads. Let's take a look at, where are we? There we go. SHYG. Right, this is just kind of chopping sideways. Credit spreads are fine. So there's nothing here that is telling you, you want to get out of the market. Now, the only thing this week that made me say, oh, it's interesting, is rotation into some of the safer names. So here are utilities. It's had a nice close to the week. I think we had Staples as well. Right, well, Staples are negative, right? Staples were negative. Utilities were the only ones that got that boost, and maybe that's just around AI. Let's take a look here. Where are we? Here's the CLOs. So this is cash. This is hanging in there. There's no big volatility that you saw during May. Here's emerging markets. Emerging markets still remain strong. The base metals remain strong. Let's take a look at the dollar. The dollar is starting to rally. Now, this is what I think could cause a bit of a pullback, is paradoxically, once again, most people think that a Fed rate cutting cycle is going to weaken the dollar. Well, the Fed hasn't cut rates in a year and the dollar's been falling. Okay. But if they cut rates, what does it do? That's less spending it's less dollars being created, less spending into the economy. It actually makes dollars scarcer. Dollar should rally. If it doesn't rally, it's actually a bad sign. It means that investors worldwide are rushing out of dollar assets. So this should continue to have a counter trend rally. Now, I think long term, the dollar is going to be in a downtrend because of our fiscal situation. But near term, it should make the dollar a bit stronger, which once again should zap liquidity over the medium term. Problem is liquidity is very, very abundant now. So it's not like liquidity is going to go from abundant to scarce. It's a process. And I think over the next year, we'll see that process play out. But once again, that's not today. There's still plenty of money to be made between now and year end, and probably well into next year. So I said this a few videos ago. I think I said we were probably in the bottom of the 8th inning of this growth cycle. It was maybe a month or so ago is when I've said that. Yeah, I still think we're still in the bottom of the 8th. Maybe we're, with 2 outs in the bottom of the 8th, but we're still there, right? So there's still a lot of time left in this ballgame. Growth to value trade is pretty interesting. It's got a resurgence. So that's another sign that you could see the market have a more significant pullback if growth starts to underperform once again. But so far, it's not. So that's where we're at. The simple answer to this question of this video is it will, but not yet. We're not quite there yet. We're still in a phase of abundant liquidity. And as we get closer and closer to 2026, it's called at the end of the year, it becomes harder for the market to structurally have any significant volatility. Volatility is likely to remain relatively muted. That's why I look at the VIX. VIX is just sitting here right around 14. That is an environment of just a grind higher. And while it's important to keep an eye on the economic data, what's more important is the liquidity that's happening within the system, that's being created within the system. And not just here domestically, but in other countries as well. For example, the Chinese central bank they're creating a lot of liquidity as well, and money is fungible. So look what's happening with Chinese equities. So all of this is the take home here is don't get too caught up in the headlines, especially when you're talking about short-term moves in markets. It's really about broader liquidity dynamics, and you should be monitoring for that more than some headline about jobs, because jobs are frankly a lagging indicator. Okay. What was happening in the spring post Liberation Day is now feeding into the jobs data. You notice it took until June, July, and frankly, getting the data in August and that revisions for June and July to really tell us what was happening in the labor market. So by the time it shows up in the labor market, the story has been told. But once again, that's one aspect to consider. The broader liquidity dynamics are far more important, and they remain robust at the current time. Thank you all for tuning in. Hope you have a wonderful weekend. Reminder that the contents of this video are for educational purposes only. It should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.